Okay. So welcome everyone to our trustee school, March 8th, 2025. We have myself, Ethan Welch, attorneys Amanda Buzo and Riley Williams as well. We'll be presenting this presentation to you guys, just about the ins and outs of special needs trusts, third-party trusts, benefits, and what's all handled when someone takes the reins of as trustee um, of our trusts for loved ones that need help. So let's just get started. So our goal here with this presentation in all of our trustee schools is just to go over the basics of benefits, because that's why these trusts are in existence. That's why we draft these trusts. That's why, you know, family members come to us to, draft these trusts to ensure that their loved ones' benefits, whether that's Medicaid, whether that's SSI, whether that's the Medicaid waivers with the Job and Family Services or Developmental Disabilities Board, that those benefits are protected. And these trusts allow those benefits to continue and the trusts to, supplement them for the rest of their life. Um, we're going to review the relationship between these benefits and the trust administration. So how can we use these trusts to benefit the, these loved ones? Because these are special trusts, we have to understand the trustee, duties and responsibilities of, administering these trusts. And then, all the supplemental things that, that are out there, whether that's programs, whether that's, hiring caregivers or care managers to ensure the quality of life for your loved ones. Um, the trustee is able to do that, use these funds to better the lives of your loved ones, the beneficiaries of these trusts. Typically, these trusts aren't funded, until mom or dad pass away, and hopefully, hopefully the family is all on board with, their, what their duties are. That, hey, mom and dad appointed me as the trustee. I have an understanding of what's going on. Um, but sometimes that's not the case. Sometimes it's, hey, mom and dad put me as trustee and I don't know where to start. Well, no matter what the case is, if these trusts are funded or, mom and dad pass away and you see this trust document, that now I'm the trustee of my sibling's trust or my loved one's trust, whatever the case may be. The first step is just sit down, read a document, and the document might not make sense, at first, but that's okay. Read the document, see what's going on, and meet with an attorney, whether that's Hickman and Lowder, whether that's your attorney. Meet with the attorney to discuss what is the ins and outs of this document. What are my responsibilities? What's my next step? Meeting with an attorney right away to put together a game plan is, you know, the best practice. Don't just, don't wait, weeks, months, meet right away to get this game plan going. So obviously, there's responsibilities as trustee. There's fiduciary obligations, there's financial responsibilities. As trustee, you are handling this money for the benefit of a beneficiary. So there's fiduciary obligations through the revised Ohio Revised Code that you have to meet. You have, the fiduciary obligation to handle this money appropriately for the beneficiary. You can't just use this money for yourself. You have to use this money for the beneficiary. You have to there shouldn't be a conflict of interest between the trustee and the beneficiary. There you have a responsibility to invest, to disperse this money appropriately. You have the duty to, have proper record keeping as trustee. There, because this is because these trusts are special needs trusts or third party trusts, and we're dealing with benefits with Medicaid and Social Security, there's an additional responsibility of reporting that a trustee has, that we have to report this trust document and the financial information to the appropriate government agencies. There's also taxes involved here that with the trust that we have to, ensure that the taxes are paid as trustee. We have to make sure that we try to reduce as much tax obligations and liability that we can. As trustee of a special needs trust or a third party trust, there's also an advocacy, provision that we put in a lot of our documents, that these are vulnerable individuals that you're the trustee of, that who's the beneficiary. So we have to advocate for our beneficiary to ensure that they're receiving the best care and support that they can through the community. Whether that's advocating to the Developmental Disabilities Board, to their providers, their caregivers, or facility, the trustee may have that obligation to pursue. If a trustee has a special skill, or representing that they have a special skill, such as if they're an attorney or if they're a CPA or a financial advisor, they have a heightened, fiduciary obligation, that they have their own fiduciary responsibilities as an attorney. If I am the trustee of a special needs trust, which I am for many clients, I have a heightened skill that so if I do something wrong, then I don't I don't only have to report to the beneficiary and to the beneficiary's family, but I also have to report to my bar. So having a heightened skill increases that
Thanks
responsibility
for
that a
giving me
trustee
the
has.
heads up,
Um,
period.
the
Doesn't always know.
it all depends on, if you have that skill or you represented that you do have that skill, whether the fiduciary obligation or responsibility also increases. And I'm going to hand off to Amanda.
Good morning, everyone. As Ethan said at the beginning, my name's Amanda Buzo. I am very honored to be here with all of you, giving up your Saturday morning or watching this on YouTube at a later time. I would just ask that we remind all the attendees to please keep yourself on mute, with the exception of the designated verbal question times. There will be 2 opportunities to ask verbal questions. Additionally, you're welcome to type in questions into the chat box, and we will address them as time allows. So moving on to fiduciary duties, what is a fiduciary? A fiduciary is someone who is legally and ethically bound to act in another's best interest. You may already be a fiduciary and you didn't even realize you had that job title in addition to parent, guardian, caregiver, loved one, sandwich maker, whatever your title is, you may also be a fiduciary. Now, the default rule is that you can't engage in self-dealing if you're the trustee, which means that if you're the trustee, you cannot borrow from the trust. You shouldn't invest the trust assets in your business or your brother-in-law's, car wash or the startup that your cousin wants to do. You are not supposed to sell things to the trust or purchase things from the trust because that is the definition of self-dealing. And you're not supposed to commingle assets. You don't put your assets in the trust unless that was part of the plan. And you don't take assets out of the trust and put it into your personal bank account. You also want to avoid the commingling of Social Security income, whether that's SSI or Social Security disability, wages and other income of the beneficiary with the trust assets, unless that's part of the overall plan. Now, the trust agreement may waive some of these requirements. Sometimes we want to waive them when we have a family member trustee. But keep in mind that if those requirements are not waived in the trust agreement, an unauthorized act of self-dealing is presumed to be fraudulent. Next slide, please, Ethan. So as a fiduciary, that can feel a little daunting. The good news is that you have the power to delegate. Co-trustees can delegate duties among themselves. So oftentimes when family members are co-trustees, maybe one's a nurse and one's an accountant. Well, maybe the nurse handles the things that are more medically related pertaining to the trust, and the accountant handles more of the financial side of things. That makes a lot of sense. Trustees can also delegate to someone else. But when you do that, you need to use reasonable skill, care, and caution. When you're selecting the agent, when you're establishing the scope of what they're going to do, and when you review their performance. If you hire an investment manager, which is very common, you will want to oversee their performance and review the statements and have quarterly or at the very least annual meetings and look to see if they're meeting the requirements of the trust and that they're meeting your requirements as the trustee. So you can also hire professional tax advisors, and we're going to talk a little bit about tax later. I know that's very exciting, so stay tuned, but we'll get into that a little bit. You can definitely hire those professional tax advisors to prepare the tax returns. You don't have to do it yourself if you feel uncomfortable doing so. And as Riley is going to discuss later on in the presentation, you can also retain a care manager, especially if you're out of town, out of state, and you'd like someone to check in with the beneficiary. A care manager is a great way to be able to fulfill your fiduciary responsibility, even when you're perhaps not local. Next slide, please, Ethan. Thank you. So as the fiduciary, the trustee has investment responsibilities. The Ohio Prudent Investor Rule basically says that the trustee needs to invest and manage the trust assets as a prudent person would do. Another term for prudent would be responsible, reasonable. Ohio tends to follow the modern portfolio theory, which is based on the idea that the greater the risk, typically the greater return. However, the greater the risk also means the risk of the returns could, if you lose money, and it's a risky investment, you're likely to lose a lot more. So the general idea is that risk and reward are intertwined. Now, diversification is required unless the trust says that they're waiving this. Perhaps if the trust owns a family business, well, it's going to be more weighted in the family business. Under Ohio Prudent Investor, maybe that's not the wisest idea, but when the trust, when the person established the trust, that they knew that they wanted to do that. And so it's documented that they wanted to heavily invest in one area versus another. But generally speaking, most trusts needs a nice diversified portfolio. As mentioned before, you can delegate to a reputable investment advisor. So this is not an opportunity to give someone a chance to kind of gamble with the trust assets. You want to work with someone who has a proven track record of being able to make sound decisions based on the circumstances. Frequently, an investment policy statement is enacted, which is just an agreement between the trustee and the investment advisor. It will identify, the trustee's risk tolerance, and will typically identify what assets can be invested in and what can't. Can the investment advisor make trades without consulting with the trustee, or does the trustee want the investment advisor to run every decision by them before making that decision? Now, trustees that are not, that are not professional trustees, so they're not a professional trust company, they frequently delegate the trust investments to a professional investment advisor. So please keep that in mind, that that's a natural result of having a trustee. Now, reporting requirements. There are typically 3 ways that a trustee may need to report things. One way is to the beneficiary or to a beneficiary surrogate. Another way is to the probate court, and a third reporting requirement is to benefit agencies. Now, for the beneficiaries, in the trust agreement, there may be a beneficiary surrogate named. A beneficiary surrogate is a good idea when it's a minor beneficiary, because I don't think we're going to be sending notice letters to a 12-year-old saying, hey, congratulations, you're the beneficiary of a trust and this is how much money's in it. So you'll name a beneficiary surrogate. If someone's under guardianship, typically they have a beneficiary surrogate, or if the person establishing the trust just thinks it's wise that particular beneficiary is not aware of the details of the trust, that's where a surrogate comes into play. Now, that notification can just be a list of the statement of the trust assets, any income, any money that came into the trust during the year, any money that went out of the trust during the year and what it was spent on, and then the ending balance. If you still balance your checkbook, or you use QuickBooks or Quicken, that's kind of what we're talking about. You can also provide tax returns, and if you're a trustee and you're asking to be compensated, which typically you are unless the trust agreement waives it, then you might have a reason to ask for extraordinary fees, and that should also be submitted to the beneficiary or the surrogate. Now, if the trust is court supervised, which many of you out there probably do not have a court supervised trust. If you do have a court supervised trust, chances are you know it. And probate courts want an accounting every 1 to 2 years, depending on which county is keeping supervision over the trust. And the trustee typically has to request authority to expend funds. Now, the third category, the benefit agencies, typically this occurs when the beneficiary is going through a redetermination for Medicaid or SSI or Section 8 housing. Also, the government agencies can ask for information at any time. And so those are 2 ways where a trustee might need to provide information to a benefit agency on behalf of the beneficiary. Because when a beneficiary is the beneficiary of a funded trust, that typically needs to be disclosed to Medicaid or SSI. And I do see a question has come in regarding maybe some of the last slides, which was why does the money have to be invested? That falls under the Prudent Investor Act, where having cash in a non-interest bearing savings account may not make sense, but it does require a review of the circumstances. I think this might be illustrated by a quick example. If I was trustee of a special needs trust for someone, it had, let's say, under $100,000 in it, and I know that they want to purchase a home, and we're going to end up spending every dollar in that trust, and that makes sense, and the trust agreement allows us to do that, I am not going to go invest that money, because when I go to buy that home on behalf of the beneficiary in a couple months, me selling investments is going to most likely generate short-term or long-term capital gains, basically taxes. It's going to be a taxable event. Why would I do that to my beneficiary? On the other hand, if I have a $2 million trust, going and putting it into a non-interest bearing account, and that money is, every time we write a check, it's just losing money because it's not earning anything, that would not be a prudent investor either. So it depends on the circumstances, the terms of the trust, and what the beneficiary's needs are.
Good morning, everyone. I'm Riley Williams, and thanks for being here with us this morning. So, trusts typically include a provision that allows for the trustee to be compensated for their work as trustee. As Amanda and Ethan just outlined, you have a lot of duties, so you are entitled to be compensated for your job as trustee. Compensation is generally based on a schedule of fees that we have attached here. It's from the probate court. Reasonable compensation is the standard, but again, as previously mentioned, if you are a person that has increased skill or is doing a lot of work with the trust, you can get fees above and beyond that of the normal fee schedule. So we'll talk a little bit about trust administration now. So there are some special challenges that come with administering a special needs trust. As the name states, you're dealing often with someone that has special needs, is receiving benefits. So oftentimes the beneficiary has diminished capacity, or they are receiving social services like Medicaid, SSI, supplemental security income, or SSDI, Social Security Disability Insurance. All of these social services are very intertwined and have oftentimes strict requirements that need to be met to continue to qualify. So that's something that the trustee needs to have a good handle on, knowing what the beneficiary is receiving, and make sure that they are maintaining eligibility for those services. With a first party self-settled special needs trust, the state, so when the state provides Medicaid funding to the beneficiary, they become a super creditor and are entitled to repayment for any amount of money that was given to the beneficiary during their lifetime. So that's also a consideration with the first party special needs trusts. And then the trustee also should consider the beneficiary's income needs. Public benefits are capped every year for SSI. So oftentimes that amount of money isn't enough to cover the needs that the beneficiary has. So what you can do then is take money from the trust to cover the extra care costs that are needed. But for other people, the benefits that they receive do cover what they need, so they don't need all this extra money from the trust. And again, as Amanda had mentioned, some trusts are supervised by the court. So if a court retains jurisdiction, you need approval to spend funds and you have to provide accountings to the court.
A question came up. Does a life insurance policy count against the Medicaid cap? So if I'm understanding your question, does it count as a countable resource for, Medicaid or SSI? A life insurance policy can be a countable resource if it's in that person's name, and if it has a cash value to it. So if someone that's on Medicaid has a $100,000 life insurance policy and the cash value is also $100,000, well, that $100,000 is a countable resource. And that's typically a whole life policy where that comes into play, where a whole life policy has a cash value to it. If a beneficiary has a life insurance policy that is a term policy, then there wouldn't be a cash value to it, so it wouldn't be a cash, accountable resource. So it all depends on what the policy is. But it could be a countable resource.
Okay, so when a trustee is beginning to administer a trust, they have some special challenges that they need to make sure that they are paying attention to. So again, as I mentioned, ascertaining the benefits that are currently being received by the beneficiary or ones that will become available. Because again, certain benefits that are received have caps on income resources. And so you need to make sure that you're maintaining eligibility for the beneficiary, because your job ultimately as trustee is to make sure that you are acting in the best interest of the beneficiary. You might also consider caretakers. So you can look at selecting someone, especially once the people who establish a trust, often, like we were mentioning, mom and dad, once they pass away, if your sibling is the beneficiary that has special needs and you live out of state, you might want to designate someone here in state where the beneficiary lives and has a support system to go in and check in with the beneficiary to make sure that they're receiving all that they need and don't need supplemental supports. You'll also want to secure services and equipment. So if there's anything that the beneficiary needs that they don't have, you can work on getting that together. And then the trustee is in charge of the trust. So that sometimes can be complicated by family dynamics, but ultimately what happens is that you have to act in the best interest of the beneficiary. So if the beneficiary is receiving SSI and they have a cap on what they can have in their bank account, you can't just give them $15,000 because they ask for it. It's ultimately not in their best interest to give them those funds and then have them lose the benefits that they're receiving. The final thing that we'll often tell people who establish the trust to do for those that are going to act as successor trustees when the people establishing it pass away is to create a letter of intent. This is something that's not part of the trust, but can be kept with the trust document that just says how they think that they want the trust to be used. You can't hold the trustee to this letter, because ultimately they have to do what's in the best interest of the beneficiary, but it's good to have it there as a guideline.
Another question came up that a person is a personal care aide as well as as the trustee of the special needs trust. And that's pretty common. Is that a conflict of interest? Potentially it could be, but that, you know, is not a real concern. And because ultimately you're looking at the best interest of the individual. Is the trustee providing the care that the person needs? Yes. Is the person being paid as, through the trust or through the government agencies? Probably. Are you using the trust for the best interest of the individual is the ultimate question. And that's typically the case. So it could be a conflict of interest, but is it a true conflict of interest? No, because you're providing the trust and the care needs for that individual. So in most circumstances, probably 99% of the circumstances, that is not an issue. Okay, so then what about, Riley mentioned, disbursement rules that, these trusts, whether we're talking about a first party special needs trust or a third party wholly discretionary trust, we don't want to just give money directly to the beneficiary because, as Riley noted, this is going to disrupt their benefits, their Medicaid or SSI. Medicaid and SSI have very broad rules of what income is. So if you give cash directly to a person, or to transfer money directly to their checking account, they're going to count that as income. And especially for SSI purposes, that would disrupt their SSI for that month and decrease their SSI payment for the next month. We advise our clients and the trustees to make payments directly to those providers, to that vendor, instead of making the payment directly to the beneficiary to then pay for those goods or services. The trustee should also be wary of paying for food and shelter expenses for that individual. SSI has relaxed the rule about food being paid from a third party, including a trust. But the shelter expense is still there. And it's still, the food is still there in Medicaid regulations under the state of Ohio, where if a third party, whether that's a parent, whether that's a trust, is paying for food and shelter expenses on behalf of the individual, that could disrupt their benefits. We get around that, with using stable accounts, because stable accounts are technically in the beneficiary's name. So if the beneficiary does need help paying for rent, as an example, the trust can provide $500 to the stable account, and the stable account then can pay for that extra rent that is needed at the facility or at the apartment, whatever the case may be, or for if they're in a home, help pay for real estate taxes and other utility bills. So there's ways of getting around that. We'll talk about stable accounts, at the end of the presentation. there's always exceptions. These are, you know, there's always exceptions to the food and shelter rules, but as a general rule of thumb, we don't want to make cash payments to the beneficiary. We don't want to pay for food and shelter expenses on behalf of the beneficiary, because if they're on Medicaid and SSI, the black and white letter of the law says, hey, that might disrupt their benefits. The big item that a lot of clients, have is a residence for their beneficiary. And many parents, many, clients want to have their home where this person has lived for, all their life or, decades. After they're gone, they want the beneficiary to remain in that home for as long as possible. We suggest having the home transferred to their trust instead of having it transferred to the individual themselves, because of, the payback. If they own the home individually, well, yeah, they can still be on Medicaid and SSI because a home is an exempt resource for the individual. But we have it transferred to their third-party trust, because if that beneficiary passes away and they're on Medicaid and they're on benefits, Medicaid estate recovery can put a claim on that home, because even though it's an exempt resource while they're alive, when they pass away, the state of Ohio can come in and say, hey, this exempt resource is not exempt anymore. We're going to attach a lien on this home. If it's in a trust, a third-party trust, well, it's not owned by that beneficiary, and there's no Medicaid payback on a third-party trust. So that's one aspect of, home ownership for the beneficiary. It should be owned by the trust, this third-party trust, as part of their estate planning. But then you have all the ancillary issues as a home ownership, as anyone does. If the trustee owns this home, we have to, make sure that this beneficiary is provided the care that they need. The care providers, the caregivers that are coming into the home, the trustee has to coordinate that with the agency that they're receiving benefits from, whether that's with the Developmental Disabilities Board through a DD waiver, or a home care waiver with Job and Family Services. Potentially, there might be roommates involved. It could be a de facto group home. The Developmental Disabilities Board, they don't really use the term group home anymore. It's a home, and they have providers that come in for one individual or multiple individuals. But that's all a consideration to help keep the cost down. Is, hey, maybe a roommate can join here. Maybe another family member, or another, a family that you're friends with also has a disabled child, and you want them to live together to keep the cost down, having services all provided in one home. But the maintenance on a home and the eventual affordability, all factor in. And that's why maybe having a roommate come in to help keep the costs down will extend the life of the trust. So that way the trust isn't just paying for all these expenses. It's the cost is, spread out between other roommates and family members. And then having roommates, that does complicate things with, other family members butting heads with you. So there's pros and cons to every situation. And it all depends on what the family, what the trustee, what the beneficiary is all comfortable with. Obviously, the insurance portion, the insurance, the utilities, real estate taxes, that's all considered for the trustee, whether this home is the best option for the beneficiary and to extend the life of this trust for the beneficiary. So sometimes this home might be just way too big for one person or even multiple people to live in there. Maybe it's just, they don't need a 5-bedroom house, and we don't want so many roommates to come live with this individual because it's just too chaotic. It's just too much for everyone to get along. So the trustee will have to make that hard decision of maybe we have to sell this home, maybe we have to downsize this home and go to another home or to a condo or to an apartment to rent or to another home to rent. So it's when a person becomes trustee, this is all, considered when you meet with the attorney to discuss, okay, what's the best course of action as part of this game plan for the beneficiary. Another big asset that, for the benefit of the beneficiary is, vehicles, whether that's a handicapped accessible vehicle, well, that's just a vehicle to help drive this individual around, whether or not the individual drives themselves. The vehicle is an important aspect to, keep them, independent. And we typically advise that vehicles shouldn't be titled in the trust just for liability reasons. Whether the title in the vehicle would be titled to the individual themselves, or it might be titled with another family member, maybe the family member caregiver. If that's the case, if we do transfer title to the vehicle to a caregiver, family member, or just another family member, we want to attach a lien on that vehicle. The trust would have that lien. We do that because if you transfer a vehicle and if you purchase a vehicle and the title is in someone else's name, well, that's an improper transfer of the asset. And that could jeopardize benefits for that individual. You're not using this trust for the sole benefit of the individual when you do that. If you attach a lien, yes, you transfer title, but the equity in that vehicle remains in the trust because that lien is there. When the trust owns the vehicle and you are in an accident, well, yeah, you have insurance, of course, but sometimes the insurance doesn't pay out or the damage is beyond what the insurance will pay for. And the trust can get sued at that point in time. So to protect the trust assets, that's why we transfer title to an individual, whether that's in the individual's name, the beneficiary's name, or in another, caregiver's name or a family member's name. But we attach that lien to preserve that improper transfer and preserve benefits. Another asset is prepaid funeral arrangements. It obviously, not a fun topic to discuss and purchase, but prepaid funeral arrangements, that's an exempt asset for individuals if they are irrevocably done. So if you purchase an irrevocable funeral contract, number one, you get it out of the way. Yes, you don't want to talk about this with family members, but it's very, everyone dies, everyone passes away, and that's one less thing that a family member and the trustee has to worry about when a loved one passes away. It's an exempt asset for Medicaid and SSI purposes. So purchasing that pre-need funeral plan before the person passes away is one less thing that you need to negotiate with the state of Ohio to get that taken care of before the state of Ohio would have that payback provision with the trust assets. A question came up here. If the caregiver has the vehicle title in his name, the lien is on the vehicle. After 10 years, the vehicle depreciated and the lien is more than the the worth of the value of the vehicle. Is the caregiver at risk to owe the entire lien? No, the lien would be the value of the vehicle. So it's, the obviously cars depreciate as soon as you start driving it. So what that lien does is it protects the trust. So the caregiver can't, for example, if we put the title in the caregiver's name, the caregiver can't just turn around and sell it the next day because they have to take care of this lien. So it's twofold. It protects it for transfer of assets, and it also protects the value of the vehicle back to the trust. So what is the prepaid? Another question came up. What is the prepaid funeral value limit? I thought there used to be one around $2,500 to $5,000. There isn't, there isn't a true limit on a pre-need funeral plan. And, the as long as the funeral plan is, number one, irrevocable, and number two, reasonable, then that satisfies Medicaid and Social Security. I wouldn't go purchase a $30,000 pre-need funeral plan because that that throws up red flags to the agencies. It could be a $30,000 plan if you purchase multiple funerals, meaning if someone lives out of state or family members live out of state and you purchase funeral plans to have one in Ohio and one in Chicago, and because that person's going to be buried in Chicago with other family members, you have an argument that, yeah, a $30,000 plan makes sense because of those circumstances. But there is no true limit. It's, what the figure that you're giving is, that's what a cremation would cost. Typically a burial is $10,000 to $15,000. It's all based off of reasonableness under the circumstances for a pre-need funeral plan.
Okay, as promised, we're going to talk a little bit about taxes. But first, I'm going to give a tip. I would recommend that if you're the trustee of a trust that is required to prepare taxes, or if you're the guardian of someone who has to consider filing a tax return, or if you yourself are an individual with a disability and you have questions about tax returns, develop a relationship with an experienced, knowledgeable tax preparer. That is going to be your most valuable tool. Looking into this at midnight on April 14th is not going to provide a restful night of sleep for you. So develop the relationship early and definitely refer to that person with questions about taxes. I'm going to boil it down to kind of policies or rules recognizing that there are exceptions. There are some different ways of doing things. But if you are the trustee of a first party special needs trust, this is a Medicaid payback trust established with the beneficiary's own assets. The trust typically gets a separate tax ID number, does not use the Social Security number of the beneficiary, although they can. We recommend generally against that. Has its own tax ID number, which means that it prepares an informational tax return, and a trust tax return, whether it's informational or not, is known as a Form 1041. So that tax preparer prepares an informational 1041, and then it is reported the income out to the beneficiary, and the beneficiary reports that paper income. It's not a check, but that paper income on their 1040. The result is that a beneficiary who maybe has never had to file income taxes before may need to file their own 1040. That doesn't necessarily mean that income taxes will be owed, but it does mean that they're likely to have to prepare a 1040 because they're receiving that tax document from the trust. Next slide, please, Ethan. That brings up a question that we often hear from clients. Well, I thought, the beneficiary could only have $967 worth of income, or I thought their resources could only be $2,000. Why are we getting this tax document showing taxable income of more than that? There is a difference between taxable income and the eligibility rules to be on Medicaid or SSI or other means tested benefits. So just because someone receives a tax document saying that their trust is reporting taxable income of $16,000 does not mean that that individual is going to lose their benefits. That's another reason why we use a separate tax ID number or an EIN for the trust, so that there's no confusion that bank account at the local bank that's actually a trust bank account entitled in the trust, that it's not reported on the beneficiary's Social Security number. So as trustee, you want to keep information about distributions so that if Medicaid or SSI ever questions it, you can explain, look, this was paper trust taxable income. This does not mean that this was income that the beneficiary has to report for Medicaid or SSI. Now, regarding the taxation of third-party trusts, third-party trusts are the type of trust that a parent or grandparent is going to establish for a beneficiary with a disability. That individual never had access to those funds directly. They're just named as the beneficiary. While the grantor, the person who set up the trust, also known as a settlor, while that person is living, it may be revocable and it's reported in their Social Security number. But at the death of the person or persons who established the trust, oftentimes the trust becomes irrevocable. And at that time, a separate tax ID number is requested. That trust also files a Form 1041, and it reports all of the taxable activity in the trust. And the beneficiaries frequently receive a tax document known as a K-1, which they then report on their 1040.
Okay, so now we'll talk about securing care management services. So a trust that has a beneficiary that has a disability or needs extra help often has an advocacy provision in it. So that's what the care management services would be used for. So the trustees can act as a care manager, or a professional care manager can be used to just ensure that the beneficiary is receiving the benefits that they need. They don't need anything extra. And then that professional care manager reports to the trustee about the needs that the beneficiary might have. Next slide, please. So a professional care manager is a health and human services specialist who typically helps families access care for older relatives or people with disabilities. So they will act as a guide, an advocate, and they encourage as much independence for the beneficiary as possible, but they'll still make sure that the beneficiary is getting all of the services that they need and are properly being taken care of. So care managers, while they will go out and be the eyes and ears for the trustee to ensure that the beneficiary is getting what they need, they can fulfill other roles as well, like assisting with government benefits. So making sure that the beneficiary is within the strict guidelines, notifying trustees when benefits might become available to them. The care manager can also make regular visits to the beneficiary. As we mentioned earlier, if the trustee is someone that's out of state and the beneficiary lives here in Ohio and they have this support group that's already here and all the things that they need, the care manager will go out, visit the beneficiary, and then report back to the trustees. Based on the visits that the care manager has, they might notice that the beneficiary needs additional things, like maybe they need some new clothes, or they have a wheelchair that's really old and the wheel's not working. So the care manager can let the trustee know that you should pay this amount of money to replace equipment or get something new. And then they also can just evaluate how the beneficiary is doing in their current situation. If there's something that, if they're in a care setting where it seems too restrictive for the beneficiary, the care manager might say, we can move the beneficiary somewhere else to allow them to have more freedoms and act themselves without so much help. And then also they can prepare an annual care plan for the trustee to say what the beneficiary might need, and again, identifying benefits and those kinds of things. So professional care managers can come from various places. Hickman, Lowder, Liederbach, and Welch actually has a care coordinator or care manager on our staff. She often works with trustees and successor trustees to be the eyes and ears of beneficiaries that are here. Hickman Lowder was one of the first firms to hire a care coordinator on their staff because they noticed that when the initial trustee passed away and the successor trustee stepped in, there might have been a gap. So when our care coordinator was working with the initial trustees, they can bridge the gap and tell the successors what needs the beneficiary has, what things the initial trustees were doing, and she can also act in that capacity with, again, visiting, making sure that the beneficiary has what they need. And trust resources are actually used to pay the cost of professional care managers taking on this role and reporting to trustees.
Well, another question popped up here. Can you have an inherited IRA and a special needs trust? If yes, do you have to adhere to the 10-year rule? So if a loved one is has a retirement account like a 401k or an IRA type vehicle, and you have the third party trust as the beneficiary, um, no, the trust would not be adhering to the 10-year disbursement rule um, for that IRA account. It will be extended based off the life, expectancy, using IRS tables, for that beneficiary of the trust. And required minimum distributions would be taken from that IRA account based off that life expectancy. So, I mean, it could be 40 years, and the trustee would make required minimum distributions from that IRA, and that doesn't mean that the distributions would be given to the individual. It would be taken from the IRA account to the trust bank account. So, in short, no, you don't have that 10-year rule that typical beneficiaries, typical children would receive. It can be extended, in a sense, as an inherited IRA for the disabled individual. So now we're going to segue to the reporting requirements to benefit agencies, like Social Security and Job and Family Services, who handle Medicaid applications and redeterminations, which we talked about a little bit about. Once the trust is funded, then the beneficiary is entitled to receive distributions. And until the trust is funded, that is when you provide the trust to the agencies, to the bank statements to the agencies, to show, hey, he has a trust, and this is what he has in the account, and this is the distributions that have been made. If a family member, or mom and dad, have a third-party trust as part of their estate plan, but it's not funded, well, no, there's no reporting requirement to give to Social Security and Medicaid at that time. It's only when the trust is actually funded, and that if they open up an account with $100, yes, that triggers that reporting requirement. You have to provide that information to these agencies that this beneficiary who's receiving Medicaid or Social Security has this trust. Sometimes the bank statements don't exactly show what this $500 check was paid out to. We always advise our clients to make sure that as part of their statements from the bank, that you get copies of canceled checks with the bank statements. That way you have the proof of, yeah, I paid $500, for tires on their vehicle, as an example. We always advise clients to, when they make a purchase from a trust, to keep that invoice, keep that receipt of that purchase, because you're not going to remember what you did 6-9 months ago in most circumstances. And if Job and Family Services or Social Security question, hey, what was this purchase made on April 5th, 2024, for $667? Well, you can go in your folder, see the receipt on that day of the check that you've made, and you can provide that information to the agency. So keeping records, yes, it's a pain, but it's your duty as trustee to keep accurate records for these agencies, so the beneficiary's benefits will continue. Social Security requirements, technically, you have to provide information, within 10 days after the end of the month in which the event occurred. Which meaning that, hey, if this trust is funded, it's funded on, October 31st, you have then until November 10th to provide the information to Social Security. I've never seen, as long as it's a reasonable delay, I've never seen Social Security, throw up their arms about that. But it needs to be given to them within a reasonable time period, and if they question why, hey, why didn't you provide this information faster or sooner, you can explain the circumstances of why the delay. The Social Security requirements, you have to provide changes in circumstances of the beneficiary's income, where they're living, a change in the accountable resources, and new eligibility for other benefits as well. So, I mean, there's a lot of reporting requirements to Social Security beyond what the trust, if the trust is established for the benefit of the individual. The other requirements, if the person is now married, if improvements of medically to this individual, Social Security wants to know that, if they're married, that might jeopardize their benefits, because now we're talking about a married couple, and their assets would be, looked at together. If they improve medically, maybe they're not disabled anymore, according to Social Security requirements. If they're admitted or even discharged from a health facility, in the hospital long term, you have to report that to Social Security. Any intended trip outside of the United States is also required. So if you're going on vacation to Italy, you have to provide that information to Social Security in case something happens to them outside of the United States that they need to know about. So a lot of reporting requirements to Social Security beyond, just the trust. I'm sorry, this is Amanda's slide. I'm taking over.
That's okay, Ethan. You are on a great roll. I appreciate that. So appealing a denial of benefits. If you receive a notice of an adverse action from Social Security or Ohio Medicaid or the County Department of Job and Family Services, it's very important that you file an appeal within 10 days of receipt. Many of the notices now actually provide the exact date on them. The reason why 10 days is so important is that you will get to preserve the benefits that they're maybe saying are going to be terminated. You can preserve those during the appeal. So you continue to get the SSI, or you continue to get the Medicaid coverage. If you do not appeal within the 10 days, you still have additional days. It's up to 60 days to appeal, but your benefits are not preserved. And then also, next slide when you get a chance, Ethan. The other things that you need to report to Social Security are substantial medical improvements, a change in the beneficiary's marital status, admission or discharge from a health facility, and as Ethan mentioned, any intended trip outside of the United States. Now, because of all of these benefit changes, and because, some of the questions that are mentioned in the chat, Things change, things evolve, and also it's not expected that you're going to remember every detail that was discussed during the initial meeting with the attorney, and it's important to check in. So the estate plan that's created should be periodically reviewed to ensure that all the assets are titled properly, to update trustees if necessary. If there's any changes in the beneficiary's medical condition, living conditions, or eligibility for benefits. If there are changes in your family life, or births, deaths, divorces, marriages, adoptions, being human, sometimes that requires changes to the estate planning documents. We generally recommend that you pull out your documents and look at them every 3 to 6 years, and definitely make an appointment with your attorney if there are any changes or if there are any questions. And the last item that I'll go over is just a reminder of what the definition of disability is. It's a physical or mental impairment that lasts 12 months or longer or will result in death, which is the part I hate mentioning. So I know I did a presentation to domestic and probate judges, and one of the domestic judges said, well, what's preventing me from setting up a special needs trust for my son who just broke his arm? And I said, well, he doesn't meet the definition of disability based on the facts you just gave me. While he does have a physical impairment, the broken arm, it's not expected to last 12 months or longer or result in death. Also, disability is supposed to prevent engaging in substantial gainful activity, or SGA. In 2025, that dollar amount is $1,620 a month. So generally speaking, if someone can earn $1,620 or more a month, Social Security will determine that they are no longer an individual with a disability, and some adjustments will need to be made.
Okay, so SSDI and Medicare eligibility are the non-means tested government benefits. To qualify, you have to meet the definition of disability that Amanda had just mentioned. You are going to start getting your SSDI payments 5 months after you were determined disabled, and you will automatically qualify for Medicare 24 months after you receive your first SSDI check, and that is regardless of age. You don't have to be 65. So SSDI is tied to work history. The general rule of thumb is that you were paying into Social Security for about 10 years. You've accrued enough work quarters to receive the SSDI payments. However, there are exceptions on the next slide. So one exception is SSDI childhood disability benefits. So you are a disabled adult child if you were a child disabled before the age of 22. Your parent is receiving Social Security retirement themselves, your parent is disabled, or your parent is deceased. So that adult or disabled adult child receives payments based on their parents' earning history. So you'll automatically get 50% of what the parent receives from Social Security. But once a parent passes away, the disabled adult child will start to receive 75% of what the parent received from Social Security during their lifetime. And it's not means tested, but as mentioned, SGA is relevant. So SSI and Medicaid are the means tested benefits. Again, you have to meet the definition of disability according to Social Security. As mentioned, it's means tested, so you can have $2,000 in countable resources As we've mentioned throughout, not everything counts. So houses, cars, stable accounts, wholly discretionary trusts, special needs trusts, those are exempt. And then there's also income levels that you have to consider. It's intended when you receive SSI to pay for food and shelter. So if someone is helping pay for that, so if you have a child that's 18 that starts receiving SSI and they're living in your house, you can get the max amount of SSI payments by creating a room and board agreement. We'll work on that with clients. Usually children under 18 are not receiving SSI because parents' income deems to the children, but once they turn 18, they can apply for these benefits. This year, the max is $967 per month. Also important to note here, that once you qualify for SSI, you automatically qualify for Medicaid. You don't need to do a separate application for that.
You know, another important note about go back to this slide about the childhood disability benefits is if they are receiving a higher amount of income and, you know, they will still receive Medicaid benefits because there's an exception to the Medicaid rules that, you know, if you are receiving benefits based off of a parent's work history, Medicaid benefits will continue. So at the end of the day, a disabled child, might be receiving $2,500 in SSDI based off of their parents' work history. They will receive Medicare, but Medicare will be the primary insurance, and Medicaid will continue as the secondary insurance. So this child couldn't, receive a higher income, be on Medicare, be on Medicaid, and still receive their Medicaid waiver, whether that's through the DD board or through Job and Family Services, but only if this child was disabled before the age of 22 is when this occurs. There is another question: are lump sum receipts of payments for underpayment by the government from Social Security counted for income purposes? No, it's not counted for income purposes, and those lump sum payments are exempt as well for a certain period of time. I believe it's 9 months. Amanda, can you? I think it's 9 months. Yes, she's shaking her head. Yes. I can't remember. I couldn't remember if it was 9 months or 12 months. But it's exempt for 9 months, and what that means is if they receive a $15,000 check from Social Security because they've incorrectly calculated past payments, that is not income. It's not an asset for the next 9 months. So Social Security and Medicaid is giving you 9 months to spend that down. If you say, well, they don't really need this extra cash, what are we supposed to do with this extra $15,000? They don't have any other needs right now. You can always put that money in a special needs trust. You can always put that money in a stable account, and it would be an exempt resource then. So there's options with that money. But if you got $15,000, you can go purchase some items for them within that 9-month period. So we're falling a little behind here. This was supposed to be our halfway point. But if anyone has any questions that they want to, ask now. Another question: can the trust put money into their able and stable account? Yes. we typically advise clients to do that in order to give more financial, independence to the beneficiary. If the beneficiary is able to, transact on their own, if they're competent, enough to do that, yes, you can put money in the fund from the trust to the stable account. Here you go, beneficiary, and you go use this money for whatever purpose that you need, whether that's to buy groceries, to, um, you know, go on a trip, whatever you want to do, that's your money. You can do that. Or if you want to supplement for, their shelter expenses, you can do that on a monthly basis and giving extra funds to the individual to, to their stable account for them to then pay their rent or utility bills at, at their apartment or house, whatever the case may be. Another question is there a maximum amount that can be held in a representative payee account for SSDI? No, there is not a maximum amount because SSDI and Medicare are non-means tested benefits. So there is no limit. But if that person is also on Medicaid, then there's that $2,000 limit that you have to be concerned about. But there is no limit for a representative payee account or any other account for the individual. Another question, is it still true that money from stable that is withdrawn and spent in the same month, it doesn't count against earning or shelter impacting benefits? That is still the case, yes, that you can use money from a stable account for food and shelter expenses. The reasoning behind that is the stable account is titled in the disabled individual's name. So the government is saying this is a non-countable resource. This is an exempt account. So you can use this money for food and shelter purposes for that individual. If an adult on SSDI for childhood disability, does Medicaid means testing still apply? It still applies in terms of the resource requirement. It doesn't apply for the income requirement. So yeah, you're receiving $2,500 a month in Social Security disability insurance, but Medicaid says you are accepted in the income rule. The asset rule of $2,000 still applies for Medicaid purposes. So that raises the question of, yeah, I'm receiving $2,500 a month, and that's going to accrue, month to month. How am I supposed to keep my account below $2,000 or the beneficiary's account below $2,000? Well, you have to transfer that. You have to spend that money to keep it below $2,000. You have to transfer that money to a stable account or transfer that money to a special needs trust account in order to keep that money below $2,000 if they're receiving, more money from Social Security and the account just adds up, and you want to keep that account below $2,000 at the end of every month. So the, income versus resources, it's all, kind of segueing from that last question here, that income received in the month is income. And like we said before, Medicaid and Social Security has very broad definitions of what income is. And that could be if you transfer money from a trust or from the parent to an individual, that would be considered income for that individual. It's not considered an asset until the next month. So in this circumstance that the last question talked about, if they're receiving $2,500 a month in Social Security, that's income for that month. Next month, if there's still $2,500 in that account, and then they receive another $2,500, well, they're over resources for that month. You have to spend down, or transfer that money to a stable account or a special needs trust account. So to make sure that that is no longer a resource for Medicaid purposes. Just, real quick, this is about income when someone is on SSI, supplemental security income. There's a lot of rules regarding SSI, and if that person is working as well, has a part-time job and receiving income from a part-time job, you can work and still receive SSI, but the money would be reduced by the amount of earned income that this person is receiving. So they go through this formula of you disregard the first $20 of unearned income, and that's unearned income from, other sources that is given to this person, or they disregard the first $65 of earned income plus 1/2 of earned income. So it's complicated, but at the end of the day, someone could be making $1,000 of earned income a month and still receive dollars from SSI. Just because they're receiving earned income doesn't mean that the whole SSI would be taken from them. There's other, these impairment related work expenses. If they have expenses in order for them to work, well, that can be discounted as well from the earned income. Deeming means that if this person is a minor child, the parent's income and assets deem to this minor child. So that's why many disabled children do not receive SSI until they reach age 18, because at age 18, they, they're no longer children to the government's eyes. They are now adults, and parents' income and assets don't deem anymore to that minor child or to that child because they're now adults. In-kind support and maintenance, if a third party, whether that's parents, whether that's a trust, is paying for, shelter expenses, that, for that individual, their SSI will be reduced by 1/3. So they won't receive the maximum $967 a month anymore. They'd receive, around a little more than $600 a month. And obviously the Medicaid spend down, which we talked about, if to ensure that they are receiving that income, we have to make sure that their assets are below that $2,000 threshold for them to continue receiving it the next month. Income is money earned or received from the government or unearned from other individuals providing funds directly to them. That's income. Resources are, what this person owns or what is available to that individual. Why do we make that distinction about availability? Well, if you have an improperly drafted trust, and the trust says that the distribution standard for this beneficiary is for the health, education, maintenance, and support for this individual, that trust asset is now available to the individual. That's why we draft our trusts to give the sole discretion to the trustee to use or not use the trust assets for the benefit of the beneficiary. That's why we call it a wholly discretionary trust, and that's why the trustee has the sole discretion to use or not use those assets. And we talked about deeming from parents to children. That stops at age 18. So no longer at age 18, will parents' assets deemed to them, because now the individual will only own what they have in their name. The exempt resources, we talked about this, that, personal items, household goods, clothing, those are exempt. Of residence would be exempt, but sometimes we don't want the individual to own the residence, because even though it's exempt while that person's alive, it could be paid back to the state if the person is on Medicaid and they pass away. A vehicle is exempt. Irrevocable funeral contracts and burial plots are exempt. Whole life policies with a total face value of less than $2,000 is also exempt. Term policies, those are exempt. The back payments for Social Security, we talked about that. That's exempt. And obviously the accounts and trusts that we help administer, the third-party trusts, the special needs trusts, and able/stable accounts are exempt.
Okay, so now we'll talk about Medicaid. Medicaid is health insurance, medical assistance traditionally. It provides health insurance, home aids, medically necessary and home care, pretty much anything that is medically necessary. As we've mentioned throughout, Medicaid is means tested, so you can have that less than $2,000 for an unmarried individual for resources, and your income is the SSI limit, so $967 a month. I think it's important to note too that Medicaid is the insurer of last resort. So if there are other policies, so if someone has dual eligibility, so they have Medicare and Medicaid, Medicare is going to be the primary, and then whatever Medicare does not cover, Medicaid will then be able to be processed and cover what they will. Next slide, please. So there's different programs under Medicaid. There are various waivers that, as stated, they assist a person who requires a certain level of care. It covers services and support that are not part of the original Medicaid plans that are typically covering health insurance and medical assistance. The different waivers can come from the Developmental Disabilities Board, and Medicaid has its own waivers as well to assist people in their homes or living in an assisted living, nursing home, etc. Then there is Medicaid Specialized Recovery Services. It is targeted toward two specific groups, those that have a severe or persistent mental illness and those with severe chronic conditions that are listed, lots of them listed here. You are allowed to have a higher income threshold, so that's that $2,901 per month. This is gross income. And then it provides various different types of resources. So if you need help with medical appointments, activities of daily living. It can also cover vocational training, recovery management, supported employment. You have to be 21 or older, and you don't have to be in a nursing facility or hospital. You can be out in the community. There's also no asset limit. Then I saw in the chat there was a question about Medicaid buy-in for workers with disabilities. So this is a program for those between 16 and 64. They meet the Social Security definition of disabled, but they're able to engage in work. There is a broader criteria here. You cannot earn more than 250% of the federal poverty level. So that's 3261 in 2025. Medicaid, again, it has this broader criteria. So it's rewarding the person that can go out and work and receive income, but they do not have to be concerned about not having health insurance. Based on how much income they are receiving, they might have to pay a premium, but they are still receiving health coverage.
Oh, sorry about that, Riley. So SSI, Supplemental Security Income. It's a federal income program for people with disabilities who do not have Social Security coverage. So as Riley explained, they don't have their own covered work quarters, nor are they eligible on another wage earner's employment history. This is oftentimes for minors whose parents have income and resources that are below the threshold, or for adults, like I said, who haven't paid into Social Security, have not been a wage earner themselves, and are not eligible on another wage earner's record. It is intended to pay for their food and shelter. It's administered by the Social Security Administration. If you are looking to apply for SSI, you can complete the disability report online, but as of right now, the application is still typically handled in person, or at least it's handled with a representative's assistance. So it's not completely online, unlike some of the other programs. To be financially eligible for SSI, your resources, if you're a single person, must be less than $2,000, and your income must be quote unquote low. There's not a set dollar amount. It actually looks at unearned income and earned income. So we generally just say the income needs to be low. Now, the maximum 2025 benefit is $967 a month if the individual is unmarried. What many people comment on is, if this is intended to pay for food and shelter, there's not many of us, no matter where we live, that can pay their rent at $967 a month, and of course have no extra money for haircuts or bus passes or anything like that. So yes, it is definitely a program that provides assistance, but it probably does not provide 100% assistance to most of the people who receive it. And if someone who is on SSI is unable to manage those payments on their own, either because they're a minor or because they're an adult who needs assistance, perhaps they're under guardianship, a representative payee can be appointed, and that person is a fiduciary. So going back to that earlier point, they would have an ethical and legal obligation to use those funds for the benefit of the SSI recipient. Now, food and shelter. As Ethan alluded to in an earlier slide, food and shelter, these rules actually changed a little bit towards the end of last year. It actually changed in the benefit to benefit SSI recipients, which is not always the case. So in a nutshell, food is no longer included in-kind support and maintenance. Now, what is in-kind support and maintenance? It's when someone else, whether it's a trust, whether it's a family member, whether it's a Good Samaritan, when someone else pays for the shelter expenses for the Medicaid or the SSI recipient. Because the idea behind this is, SSI or the Social Security Administration will say, hey, this $967 a month is meant to pay for your food and shelter. So if you're getting that for free somewhere else, we're going to assume you don't need all of this $967 and we're going to reduce your benefit. And so now food is not included in that. So someone can have those restaurant meals or those groceries paid for by someone else and not jeopardize their Medicaid or SSI. Now, with respect to shelter, shelter is actually defined as 10 things. And it includes the things you must have to live: rent, mortgage, water, electric, sewer, those kind of things. It doesn't include internet. It doesn't include cell phone. While we might think we need our cell phone to live, the Social Security Administration does not agree. So they don't consider that part of shelter costs. So if someone pays your rent and you don't contribute anything and you receive SSI, your SSI is going to be reduced by the value of the in-kind support and maintenance. But if the SSI recipient pays about $343 a month towards their rent, someone else, a trust, a parent, can pay the remainder of their rent and not lose a dime of SSI. And I'm going to illustrate this in a minute, but I do want to point out that if anyone here receives Medicaid, but they don't receive SSI, Medicaid is still, technically they're still considering food as part of ISM. But if you're on SSI and Medicaid, Medicaid will follow Social Security rules, which says that food is no longer penalized. So if we go on to the next slide with the case example, John receives SSI. John's mom gives him $50 every month for online gaming. That is countable unearned income to John. So his SSI is going to be reduced by $30, which is the $50 his mom gives him minus that $20 disregard that was mentioned earlier. So his SSI is going to be reduced by $30. If John's mom is not giving him the money as mom, but she's giving him the money as trustee of his special needs trust, what will happen? Same exact thing. He's going to have his SSI cut by $30. So the takeaway is if you give an SSI recipient cash of more than $20 a month, their SSI benefit is going to be reduced. I don't recommend giving someone on SSI cash, even if it's under $20, because it just raises some red flags. Going on to the next example, let's talk about shelter, rent. So John's mom pays his $900 rent. She just pays it, straight to the landlord. Or she gives him the $900 and he gives it to the landlord. Either way, John's SSI is going to be reduced by $880. The amount of the rent minus the $20 disregard. That is a lot of money, especially if he's receiving $967 a month. That is a huge chunk out of his SSI benefit. Now, let's say John instead takes his SSI and pays $343 towards his rent, and his mom or his trust pays the remaining $557. SSI won't be reduced. So the takeaway here is that payment of shelter by a third party is going to reduce the SSI, but only if the recipient doesn't contribute at least $343 a month towards their shelter costs.
So transitioning to, Well, here's a question that just popped up before I move on to the transition here. What if a parent is landlord? Can decreased rent be charged? Yes, but in order in order for benefits to continue, the parent or the child still needs to pay rent to the parent landlord, as so they're not receiving free food and shelter, which is in a part of in-kind support and maintenance. So as long as that child is paying a rent to the parent of at least the 343, the SSI will not be affected. And that's with a room and board agreement or a lease agreement between the child and the parent landlord to provide that evidence to Social Security.
Ethan, if I could just ask you, would you agree that the rent needs to be reasonable or at least close to fair market value? Like if a parent wanted to charge $1 for rent, is that going to work?
Right. That's not going to work. It needs to be um, it. What we advise our clients is, to take at least the household expenses of what for the household in general, what is the cost to keep the household running? What is the mortgage? What is the utility bills? The real estate taxes, the insurance, divide that by the number of people that live in the house. That should at least be the amount that's owed to the parent. The other question is room and board paid to parent included in parent's income for taxes. The there's not there's not great guidance on this because some clients do include it as their income, and they do that just, for protection of their own, protection to show that this is not, quote unquote, a sham arrangement, that there's documentation for, yeah, I'm being paid rent um, and I'm reporting that to the government. But there's other guidance out there that this is not true rent for income purposes. It's more of a reimbursement of household expenses that don't need to be included as taxable income for rental. We advise to just double check with your CPA, and it's a mixed guidance out there. Some CPAs would require it to be included as income on their tax returns. Some CPAs are a little more adventurous and say, no, this is just a reimbursement for household expenses that don't need to be reported as income. So I would defer to an accountant on that issue. The Back to the slides then, a transition timeline for age 18. Obviously, when you turn age 18, this child is now an adult. Benefits start to, open up for this individual, whether that's SSI or Medicaid. But now that this person is an adult, there's legal decision making that need to be taken in an account. Is this person competent, or is this person incompetent? Does this person need a guardian or guardianship alternatives available, like a power of attorney? A quick note about the term incompetent. This is a legal term determined by the local probate court, by the probate judge, to determine, can this person make financial or healthcare decisions or not? The judge looks at the totality of the circumstances of who this individual is, what the medical evaluation determines and what the court's own investigation through a court investigator will determine. And the judge then makes a decision of whether a person is incompetent or competent. Incompetency is not incapacity. So someone can have capacity at one point and you know and then recover their capacity. Um, think of you're in a car accident and you're in a coma. Well, you don't have capacity anymore because you're in a coma, but you wake up and you recover, your capacity recovers. Um, or think of someone that has dementia and, you know, with a lot of our elderly clients, dementia cap- capacity with dementia comes and goes. Until there is a legal determination of whether this person is incompetent, the capacity, the person might have capacity in the morning and then at night lose capacity. So capacity and incompetency are different terms here. But, if someone becomes age 18, that's when you should work with your attorney to determine, hey, do we need to go with the guardianship route, or can we do other means like a power of attorney in order to get information and receive information from banks, hospitals, doctors, in that way. Um, as a recap, when a person turns 18, they are eligible for SSI. If they are disabled before the age of 22, they can receive these additional benefits from Social Security. If a parent retires, becomes disabled themselves, or they pass away, and they will then receive SSDI based off of their parents' work history, and eventually receive Medicare after a 24-hour or 24-year or 24-month probationary period. The trusts that we use, um, we talked about this with a third-party trust and a self-settled first-party special needs trust. It all determines what trust we use by who owns the assets. If it's owned by the individual, or they have direct control over that, or they receive money directly from an inheritance or a Social Security back payment award, or from an injury case, from a settlement or a judgment from the court, then you have to put this money in a first party special needs trust, which has a Medicaid payback provision. If a parent decides to set aside money for an individual, we use a third party trust, which does not have this Medicaid payback provision in it.
So as Ethan was saying, third-party trusts are very useful planning tools. However, third-party trusts with inaccurate language are not helpful and will likely cause the beneficiary to be ineligible for means-tested benefits. Ohio Medicaid reviews trusts, and specifically third-party trusts, rather carefully to ensure, strict compliance with state law. And Ohio does have some code sections, including a very specific code section regarding when a trust is a countable asset or countable resource and when it's exempt. So it's important to work with an experienced special needs planning attorney to ensure that third-party trust does meet the exemption standard. There's also another kind of trust that we want to mention today, which is the sole benefit trust. This is a planning opportunity when someone needs long-term care and they have a child, a grandchild, or a sibling with a disability. So the sole benefit trust is created by the person who needs long-term care Medicaid themselves for the benefit of someone else who also happens to have a disability. Now, the really neat thing about this trust is that it's mentioned in Ohio law. There's no waiting period. There's no transfer penalty. And there's no 5-year look back for the person who created the trust and putting their assets in the trust, nor is it counted as an asset for the beneficiary with the disability. So it's frequently a win-win on both sides. Now, another kind of trust that we've talked about today is a self-settled trust. The term special needs trust typically is used when the beneficiary is an individual with a disability and when they may need government benefits, whether those are means tested like Medicaid or they're not like Medicare. Two types of special needs trusts that are Medicaid payback trusts are found under the code in the D4A section and the D4C section. It's probably not particularly interesting to all of you, but it is to attorneys because they want to make sure that the trusts that they draft meet those code requirements. Now, why would we use a self-settled trust? I get this question a lot and I love it. It always makes me chuckle. I meet with someone who is on means tested benefits. Maybe they're receiving a lump sum from Social Security. Maybe they're receiving an inheritance. Maybe we have to deal with some child support issues. And I explain the different kind of trusts and they go, you know what? I want that third party trust. I don't want the Medicaid payback trust because when I pass away, I don't want to repay Medicaid. And it makes me laugh because it's not a choice. As Ethan mentioned, it's who owned the assets, who had access to the assets, were the assets available to the individual with the disability. If so, then the Medicaid payback trust is one of the few trust options that are available. We don't get to choose to avoid the Medicaid payback part. Now, the Medicaid payback trust is established by a parent, grandparent, guardian, court, or a competent adult beneficiary. The beneficiary must be under the age of 65 and they must meet the disability definition. It doesn't mean that they have to receive Social Security disability or SSI, but that is very helpful because it makes clear that Social Security has already evaluated them and made that disability determination. Now, as I mentioned, the Medicaid payback trust, which is a type of special needs trust, it does pay back Medicaid at the passing of the beneficiary out of those trust assets. And there is no age to it. So some of you may be familiar with Medicaid estate recovery, like Ethan mentioned, or you've had a loved one in a nursing home and they're elderly and you've heard about Medicaid estate recovery. The Medicaid payback trust must repay Medicaid at the death of the beneficiary, no matter their age. Now, there's a separate kind of Medicaid payback trust, which is the D4C trust, the pooled Medicaid payback trust. And the difference between the two trusts is that this pooled trust is managed by a nonprofit, and it comes with its own trustee. So this can be helpful when someone says, I don't have anyone to serve as my trustee. This is oftentimes an option. A designated advocate or a similar term is used to identify someone to represent the beneficiary to the nonprofit. The person with the disability who's the beneficiary can serve as their own designated advocate, which can be helpful in many situations. And the designated advocate is the person who requests distributions and requests information. If Medicaid wants a copy of the trust, the designated advocate is communicating with the nonprofit and requesting that information. There's less direct family control. You don't get to choose who the trustee is. You don't get to choose the investments. But that also means there's less responsibility. So you're less looking like a fiduciary and more looking like someone who's providing some assistance. And one difference between the earlier trust and this one is that the beneficiary can be 65 or older. So this is a helpful tool for people who don't need a Medicaid payback trust until they're over the age of 65. This is one of the planning techniques that we have.
So we are at our 2 hour limit here, and you guys have asked so many great questions that we kind of fell behind schedule here. The remaining slides talk about the ABLE Act, which is the federal program. Ohio calls it STABLE. Very useful tool in the toolbox for our trustees and our disabled beneficiaries. What I'm thinking that we'll probably be doing is we'll put together a blog post about the stable and able, and and provide that to everyone and provide that on our website, just so we cover all of our bases on this presentation. Yeah, I was going to ask if anyone has any other questions, feel free to ask them now. I've got one. My adult child is on SSDI, Medicare, Medicaid. When I start to draw my Social Security, does that trigger him to get 75% of my amount, or is that only at my death? That is only at your death or his, his other parent's death. And Social Security determines, what's the higher amount. They always look at the highest earner. So if a parent passes away and they're going to receive more Social Security based off of the deceased parent's income from Social Security, they'll go to that person. And if the other parent then passes away, who's the higher earner, it will go to that individual. So it all depends on who's the higher earner. Fortunately, they look at the highest amount that this individual should be receiving. So does anyone else have any other questions? Okay, great. Well, like I said, we're going to post something about the Stable and Able Act. It's an important tool here. Thank you for your time and attention. You guys asked great questions. We really appreciate that. It breaks up the monotony of hearing us talk. So thank you for that. We will, like I said, we recorded this. Just give us, a week or so to, get this uploaded to the website. The slides will be available, and look out for that blog post as well. So thank you, everyone. You have a great weekend.
Bye-bye. Thank you, everybody.
Bye, thanks.